Welcome to ETF TV, your insight into the world of exchange-traded funds, issuers, and investments. I'm Margareta Hricova, and joining me today is Seana Smith, Senior Vice President and Senior Investment Strategist at Global X, and Deborah Fuhr. Welcome, Deborah and Seana.
Deborah and Margareta, thank you so much for having me.
It's great to have you on the show today, Seana. What is your outlook for 2026?
We think the setup is very constructive heading into the new year. The fundamentals remain strong. Confidence has certainly returned to the market. That, of course, being helped by the increased probability of the Fed cutting before year end. That's really helped extend the most recent rally. But even just looking underneath the surface, things do look solid. You have earnings growth. They have been strong. It's been enough to support the current valuations. Also, the expectations for double-digit earnings growth next year. We expect that to really be a meaningful driver for the market. We're also in the very early innings, we believe, of the AI investment cycle, and we expect that to continue to accelerate. You have revenues tied directly to AI. That's growing at double-digit rates and remains a powerful long-term catalyst. And I also think it's important to step back and as we talk and try to evaluate where things stand overall right now in the economy, the consumer is holding up. Yes, there's been a bit of softness. We got that retail sales number out earlier this week. It was a bit of a disappointment on that month-over-month number, but year-over-year, retail sales were up 4.3%. That's healthy growth across most categories. And then even the major earnings reports from Best Buy, from Walmart, from some of the other names, including Dick's, was even pretty strong, really pointing to the fact that the shopper has remained resilient. So we think that really points to a strong, potentially holiday season or good momentum going into the holiday. So putting it all together, there is a lot to be encouraged about when you look ahead to 2026. And we do see this path of least resistance, at least for now, continuing to point to the upside.
What are some of the key concerns you're hearing from investors right now?
There are a number of concerns, especially with the market at the current levels. And I think speaking to that first and foremost is valuations. We believe, yes, they are high, but we don't think they're unreasonable. And I'll tell you why. Market multiples right now, they are in the 20s, but we have profit margins, you have cash flow growth. That's continuing to improve. And we really think that supports today's valuations. It's also important to point out that historically speaking, valuations haven't necessarily been a reliable predictor of the market's moves over the next 6 to 12 months. So elevated multiples alone, we don't think are a red flag. Another topic that's very front and center for investors right now and a top concern we have been hearing has been whether or not we are in an AI bubble, especially when you look at the outperformance of so many of these large cap tech names. I want to make it clear, we do not believe that we are in an AI bubble. AI is being funded by real cash flows. You have 2026. We expect that to bring a monetization super cycle with the massive spending by big tech, which has really proven to be resilient. I think also when you take a step back and take a look at the infrastructure story, AI infrastructure deals, they're getting bigger, they're getting more frequent. You have US data center builds here in the US. It's at an all-time high, but still though, the infrastructure remains supply constrained here in the US. There simply is not enough compute capacity to really meet emerging demand. So we do think that the factors that make the case here for AI fundamentals are getting very strong here. It's hard to ignore. And we ultimately see that driving the bull case here going into the new year. I also think there's some questions just about where things stand with the global economy and then also specifically with the US economy. Because when you take a look at the most recent reports, they have been a bit confusing. You have consumer confidence in November falling to the lowest level that we have seen going all the way back to April. You do have a labor market that is holding its weight somewhat, but it is starting to weaken. You have unemployment rising to 4.4%. Putting that in perspective, that's the highest level that we've seen in just about 4 years. We also had the latest reading on inflation, the PPI number, headline number coming in at 0.3%, the annual number keeping things elevated at 2.7%. So there are some things to be concerned about. And I think as investors look at this, you might be having a tough time squaring the market's reaction to some of these concerning reports. And I think that's important to point out because investors may be now getting a little bit more confident that the Fed is going to cut once again before the end of the year. Right before I came on with you guys today, right now, investors are pricing in about an 85% chance that we are going to get a cut in December. We do agree to this to some extent. And I think even going back before the most recent data this week and going back to the September jobs report that we got last week, yes, it was delayed because of the US government shutdown. But still, when you take a look at that report, there was some weakness, but it was solid enough to put to rest some of the fears of a spiraling jobs market, but not strong enough to necessarily take a rate cut before the end of the year off the table. So I think all this to say that we view the consumer as still spending, overall healthy. Growth is not expected to fall off a cliff. And if you do have the Fed lowering rates once again before the end of the year and expected to lower again at least once in the first half of next year, it's something to be encouraged about. We expect a strong and a positive reaction from the market. So something we are going to continue to follow closely. But of course, when it comes to the economy, any sort of weakness, we're not necessarily sounding the alarm just yet.
That was a very interesting and comprehensive update. Where do you see opportunities today for institutional investors?
It's probably no surprise. One of the most compelling stories that we do see in 2026 investment wise is this next phase of AI. There's been so much focus on AI applications and hardware, but I think when you take a step back, 2026, we really expect it to be a prove it moment for the trade. We expect to see broader monetization. So in addition to some of those larger cap tech names that we've really had so much focus on, we also think that phase two brings a lot of interest. Data centers, chips, really poised to accelerate as that global AI build out continues to strengthen and continues to dominate the market narrative. I also think it's an interesting trade when you take a look at the energy side of the AI story. This is also something that's starting to get more and more attention. We talk a lot about the resources that are needed, the infrastructure needs that are tied to the ballooning AI demand. And I mentioned the larger cap tech names. CapEx clearly is not slowing down anytime soon when it comes to the AI trade. So of course, you got to look for the names that are going to support the long-term needs for energy resources. So think trades like uranium, natural gas. We really expect that to continue to benefit here as phase two and phase three of the AI trade gets underway. I also think it's important to point out just where we are in the tariff story, because there has been lots of questions from investors about how they should trade this, what exactly this means for balancing their portfolio. So while tariffs are in the mix, domestic infrastructure, we think, is well positioned. Companies generating the majority of their revenue here in the US, we really do see them as being well insulated from rising costs due to tariffs and really having an advantage against most of their overseas competitors.
That was a very interesting update. Thank you for joining us.
Thank you so much, Seana, for sharing your insights with us today. And a big thank you to Global X for sponsoring this episode and to all of you for watching. To watch prior episodes and to stay updated on news from the ETF industry, visit us at etftv.net. Thank you.